Hi, everybody. Hi, Klaus.
Hello.
Hello, Carlos. And good to see everybody else.
Yeah.
I saw Danielle earlier, Cynthia.
Hello, everybody.
And Philippa may be also there.
Hi, yeah.
Hello.
Nice to see you again.
I will wait a few seconds more to allow people to come in, and then we start. Okay, good afternoon, everyone, and very welcome to this webinar, this CEPS Intereconomics conference. I'm Cinzia Alcidi, I'm Director of Research at CEPS, and I'm really very pleased to be on screen with such a nice lineup of speakers and colleagues. The topic of this conference is Redesigning EU Fiscal Rules after COVID-19. I'm sure for those who are connected, this is really not a new question, but it's certainly one of high importance at the moment. Just as a brief introduction, the debate about fiscal rules actually started well before COVID, and it was stopped because of COVID. Then, of course, the rules were put on hold, and the escape clause was activated. But now it's time to really think of what will come after, in particular in 2023, when in principle, either a new fiscal framework will be in place or the SGP will be back at work. Now, a few weeks ago, the European Commission has launched open consultations in order to get all the views from all stakeholders in order to increase the transparency and the participation of stakeholders in the process of reform of the framework. And somehow the discussion we're having today hopefully will also contribute to that process. For the moment, I will leave it here, and I will give the floor to Christian Brewer from Intereconomics for his welcome words. Christian, the floor is yours.
Yes, thank you, Cynthia. It's a pleasure to open this conference together with CEPS. We, as editors from Intereconomics, which is a journal on European economic policy, are very happy to highlight that topic together with CEPS. We are happy that all the speakers are here today. Thank you Cynthia, that you also contribute to that conference later on, and Daniel, for hosting the next or the first session later on. Today the topic is redesigning EU fiscal rules after COVID-19, and indeed the topic is since a long time quite important. We had the financial crisis, Euro crisis. We invented or extended all the fiscal rules, and they were quite controversial. They became more controversial during the debate on the interest rate and the growth rate divide, and after the COVID crisis, of course, became even more controversial because we were just talking about it. There's the new German government, and it has a new coalition treaty. And just to quote one thing, because this is coming out since last week. The stability, the coalition in Germany says, or wrote, the Stability and Growth Pact has demonstrated its flexibility, but on the basis, we want to ensure growth, debt sustainability, and sustainable and climate-friendly investments. The further development of fiscal rules should be ensuring these objectives. So I thought that and there's a next sentence: the SGP should become simpler and more transparent, also in order to strengthen its enforcement. So this is just the piece of the new German coalition, I think there's something we can learn here, that also Germany could support a kind of reform. There were other reforms also before, and I think it's quite valuable at this stage to talk about it. I will introduce our keynote in a minute. We have a keynote, 2 sessions, just for everybody to note. All the sessions will be recorded. All the speakers are later on invited to contribute an article to our Intereconomics forum, which is supposed to be published in January 2020. For the audience, everybody has the possibility to interact. We will have a very short Q&A function later, and you should be aware that all your statements will be recorded. So now it's up to me to introduce the keynote, Mr. Carlos Cuerpo, who has a more Spanish perspective. Probably he has been recently appointed Secretary General of the Spanish Treasury on August 24. Carlos Cuerpo is an economist and was the Director General of Macroeconomic Analysis at the Ministry of Economic Affairs. He served at the Spanish Independent Authority of Fiscal Responsibility. And in 2014, Cuerpo worked as a national expert in the DG ECFIN. He has different EU and national perspectives and knows the SGP negotiations since a long time. Today, he will give a keynote on economic recovery in the age of COVID-19. It is a pleasure to have you here today. Carlos, the floor is yours.
Thanks a lot. I'm going to try to see if I can share screen, because I have a few slides accompanying my words. So let me see if it works correctly. Okay, there I go. So please let me know if you can see it full screen. Okay, nobody shouts, so I guess it's okay.
Oh, yes, perfect.
Okay, thanks. Thanks a lot. Good afternoon, and thanks, Christian, for your introductory words. It's a pleasure for me to be here and participate in this online seminar today. It's really a privilege to be part of the event, where we will hear firsthand the views of distinguished academics and then high-level practitioners on how to redesign EU fiscal rules after COVID-19, which is a very, very timely topic. My intervention here is only a scene setter, drawing on the Spanish and the European experience. And I hope this can be useful to you and also contribute to shed some light on the main challenges ahead. So I would like to structure my words on the recovery in the year of COVID-19 around 3 main topics. So the first one would be, where are we? Taking stock of the extent of the recovery and of the transformation of our economies throughout the last year and a half. Second would be how we got there, basically taking stock of the policy response undertaken both at the European and national level to achieve the recovery. Third would be what next? So the discussion on common priorities for what lies ahead. Of course, I expect that today's focus would lie on fiscal rules, but somehow we should not lose sight of the global picture. So one important message here is that we need to look for consistency in the wide range of interdependent policies that are part of our common agenda going forward. So let me start by looking at how the recovery is getting or gaining traction. So although, of course, we know that recent developments have shown that the pandemic is not yet behind us, the fact that we are able today to talk about the future of the EU somehow highlights how much things have improved, and although risks and uncertainty are still present, we can say that the overall balance of risks has become brighter over the past few months, and the recovery of our economies is outperforming initial forecasts and is more robust than anticipated only a few quarters back. Of course, it is mainly the result of the bold and coordinated economic policy response that has been adopted at the national and at the EU level, together with, of course, the very high vaccination rates that actually have allowed us to lay a solid foundation for the recovery, which you can see here in the slide as well, how for Spain, we have witnessed a clear turning point in the economic situation since March, on the back, as I said, of a strong vaccination improvement. Growth has been accelerating in the course of 2021, and basically the main sign of the outstanding dynamism of the recovery is the labor market. Here, of course, we have to be aware of the differences between this crisis and the global financial crisis. So for the past 21 very long months, many things have changed. So the virus has hit us when we had barely recovered from the previous financial crisis. As you see on the graph, it took Spain 10 years to recover employment levels, also GDP levels, and up to 12 years, depending on whether we look at affiliation or hours. In some instances, or some very important variables, such as inequality, we had not even recovered from the financial crisis when the pandemic hit us. But this time is actually proving to be different in many respects. When you look at the policy response and the elasticity of both employment and public revenues to GDP development, as you can see on the slide, the picture is very different from what we had during the last recovery. So employment has reached now its highest level since 2008, with more than 20 million people in Spain which are employed. And the number of workers under these short-term working schemes has declined very fast. So we have already recovered pre-crisis levels of effective employment, as well as other indicators such as unemployment and youth unemployment. So this is clearly much better than we could have anticipated, any analyst or institution would have anticipated only 1 year ago. But reaching the current situation, of course, has only been possible thanks to the unprecedented, innovative, I would say, and coordinated response to the crisis that has been implemented both at the national and, of course, at the European level. When we look at the different measures that took place, of course, this coordinated response at the national level included, as I just said, short-term working schemes, but other very important instruments, such as public guarantees and a wide variety of measures that actually helped support and cushion the shock for firms and households. And again, this is partly possible thanks to the activation of the general escape clause and the shift towards a more qualitative surveillance in the EU framework. Of course, the second element, aside from the coordinated national response, is the decisive response at the European level and from the European institutions, including, of course, the ECB and the European Commission, which again have proved instrumental in order to increase resilience in the midst of a crisis. And then third, we could also include common safety nets that were used during the pandemic, such as SURE, an embryo of a potential unemployment reinsurance scheme. This time, therefore, our collective response has been different, and we should all be proud of what has been achieved so far. We have provided a response that is not only different in size, but also on substance, a response which is consistent with our vision of more sustainable and inclusive economies that will bring our countries or member states closer and not further apart from each other. I think we have ensured at the same time a stable financial framework, helping prevent future financial crises, and at the same time allowing governments to make the right calls to minimize structural damage. So the bottom line, in short, is that common and coordinated solutions have worked and are clearly worthwhile. We must continue to act and prevent the economic recovery from derailing, rather than wait and see if the rebound holds itself. As the saying goes, it is always better to be safe than sorry. In this sense, the first or the most pressing issue, once getting outside of the emergency response, is, of course, to get into the minimizing of the scarring. We should avoid cliff edge effects, encompassing the phasing out the phasing in of economic activity with the phasing out of support measures, making sure that the transition to the recovery mode is as smooth as possible. And as I was saying, we have already seen the benefits of prevention through the emergency response, and we have successfully so far prevented scarring or structural impacts on our economies. We are now, therefore, gradually shifting from an emergency mode to a recovery mode. And this is requiring a transition from broad measures to more targeted actions that will facilitate the reallocation of resources and at the same time protect the most affected and vulnerable parts of the society. You can here see in the slide how specific direct measures aimed at those sectors that were most affected by the crisis in Spain will actually help them recover pre-COVID solvency positions. So in this line, in the short term, fiscal policy needs to be targeted, but still supportive until the recovery takes hold and uncertainty starts to fully recede. Of course, we know that risks remain in the short term tilted to the downside, and uncertainty remains very high due to the new waves of COVID-19, which are rapidly expanding in many countries. And at the same time, we have supply side disruptions together with the increase in energy prices, which are leading to short-term inflationary pressures. These developments show that we have to be prudent and avoid complacency, remaining flexible in our policy response and support. What are the key aspects for the future of Europe after these first few considerations? So as we are emerging now from the crisis, the challenge is to make sure it is not just a short-run bounce back, but we have a real transformative process that actually puts the EU on a sustainable and stronger growth path from the economic, environmental, and social perspectives. And national and EU agendas have been moving forward, as we said, from an emergency mode to a recovery mode, focusing, of course, on structural policies that will be key in the medium to long term. This is a very important reform momentum, both for member states and also for the EU. I believe that the coming months open a window of opportunity to shape the recovery and the economic model for the future that we should, of course, not miss. At the national level, with the implementation of the recovery and resilience plans, and at the EU level with very intense and fruitful discussion on the key strategic files, among which the economic governance review stands out as a top priority in our agenda today. Let me go first through next generation and the recovery plans, which I consider instrumental. At a national level, ambitious recovery plans have generated, since their inception, positive expectations amongst businesses, citizens, and the society in general. Now that the whole system is finally up and running, and that reforms and investments are accelerating, we expect to see a very substantial impact on the real economy, both in the short term, but also in the long term, reinforcing potential output. Basically, the combination of investments and reforms is a very powerful tool. In this sense, the Spanish plan is also particularly ambitious, with almost 70 billion in grants, which will be complemented with a similar amount of loans at a later stage, implying an unprecedented volume of funds, even compared with the funds that have historically been allocated through the EU budget. The plan will play an essential role in Spain to address the investment gap of our economy as compared to our European peers, but also comparing to previous crises. In fact, as you can see on the slide, investment dropped dramatically in the last crisis and had not recovered since. The public investment usually suffers, as we all know, from post-crisis consolidation efforts, hampering long-term growth potential. So the plan will hopefully reverse this trend, providing a much-needed boost to investment in Spain and other countries. Basically, beyond the volumes needed and involved, the Spanish plans also ambitions large number of needed structural reforms, which are placed on an equal footing to investment. So, as I said, the combination of investment and reforms is a key to unlock all the potential of the plans. We have already carried out an important reform over the past year and a half, and we have front-loaded the most relevant reforms of the plan to the first 2 years. The specific design of front-loading both investment and reforms will reinforce the effective implementations of the plan. Of course, as I said, this is not only important for Spain, given the very strong interlinkages between our economies and what is at stake in terms of also cross-country spillovers. We should all be equally interested not only in deploying our own national plans, but in making sure that all plans are successfully approved and implemented in order to foster those those benefits across the EU. Because the more our European neighbors grow, of course, the more we will ourselves grow. There is a qualitative element also related to the focus of the plan. Of course, it is the fact that we have set up at the EU level 2 clear priorities, the twin transitions for the future of Europe. And thus, we actually have huge investment plans which are related to the green and the digital transition that have to be addressed over the coming decades. On the green side, we have to deliver on ambitious objectives under the European Green Deal, which provide a compass for our joint action. Beside the key contribution of the recovery plans, we will strive to make progress also on other fronts, starting very soon with the Commission's upcoming proposals under the Fit for 55 package. There's also a matter of intergenerational fairness when it comes to the green transitions. Of course, the consequences of not acting now are difficult to assess and quantify, but the best and most recent evidence suggests that major disruptions could occur in the absence of bold preventive actions. So not doing enough now would mean increasing future environmental, social, and economic risks. In other words, building up significant contingent liabilities that may threaten our future. For this, the mobilization of public but also private funds will be needed. On digitalization, it is evident that the future of Europe is more digital, and we should trust the enormous opportunities for citizens, businesses, and public administration that the whole process brings. There's a huge opportunity cost of not investing sufficiently today on the digital technologies that will determine the competitiveness of Europe tomorrow. We must embrace this historical opportunity and avoid that Europe falls further apart in the global scenario, where, of course, other international players are rapidly moving forward. Here, the national recovery plans are instrumental to pivot from the emergency to the transformation mode. They must be key and a key lever here that will allow for an exit strategy that will deliver 2 positive goals at the same time: a growth-friendly consolidation, as we see here on the slide, for the big EU countries, where we see a downward path foreseen for the next few years in the deficit to GDP ratio, avoiding at the same time cliff effects and accommodating the ambitious investment programs and transformative reforms that the twin transitions require and that are embedded in our recovery plans. In this context, and I'm coming to the economic governance review, the relaunch of the debate on the governance framework is particularly timely. Over the past few months, due to the pandemic, we know that the urgency of the reform somehow has increased. The new communication that was issued by the Commission last month confirms that the shortcomings that were evident before the pandemic have not disappeared. They have become even more relevant. Of course, first, government debt levels have increased since the outbreak of the pandemic, and in many European countries, there are high levels of public debt. And the question that we must answer is how the adjustment can be done more efficiently. Ensuring public debt sustainability is, of course, an issue that we will have to address by undertaking growth-friendly consolidation strategies. Second, as mentioned before, in the coming decade, we will need to undertake a bold agenda of investments in order to keep up with the green and digital transitions. The investment gap will be in the range of 650 billion per year, according to the Commission's estimate. Since the investment needs, a share and spillover across member states can be significant, there is also a clear case for a closer European coordination under a common framework. Of course, to foster global competitiveness and increase the well-being of future generations. We need to prevent investment from becoming once again the first victim of our consolidation strategies. And third point will be that the EU is facing several structural challenges that will pose additional burdens for public finances in the coming years, and we have to factor them in, such as aging population, slow digital transformation vis-a-vis our main competitors, and of course, risks associated to climate change or rising inequalities. So for this, let me go on with the potential avenues for reforming our fiscal framework. As you know, the discussions will intensify in the coming months with a view to hopefully reach a broad-based consensus well in time for 2023. Of course, we won't deny that the discussions are likely to be complex. They have been in previous reform, and it's going to be, of course, the case now. However, I think that we can push for a very ambitious calendar of negotiations and have quality results if we start the discussion by recognizing that there is already a good basis for consensus. For example, We all share the need to reform the current framework to make it more simple, realistic, credible, and to improve enforcement. I think there was already a consensus pre-COVID on these issues, and a consensus can be built going forward based on three crucial ideas that come out of my analysis. So first, there is a need to define credible public debt reduction strategies. In order to, for these strategies to be credible, they cannot jeopardize the recovery. They need to be growth friendly. Long-term debt sustainability also depends on the ability, of course, to have long-term growth. The second idea would be the need to address the investment gap by mobilizing both public and private investment in areas such as the green and digital transitions. This is an unprecedented situation which we are facing now, and we need to create this virtuous cycle in which both financial and environmental liabilities are reduced. We all agree that we need to find ways to avoid repeating past mistakes and strike a better balance between consolidation and investment needs. The third element would be the fact that the existing framework is shown to be somehow at some point excessively intrusive, and the commitment-based approach of the Recovery and Resilience Facility and its multi-annual characteristic can be a useful source of inspiration for reforming the Stability and Growth Pact, promoting a virtuous circle of increased national ownership, which is key, and improved enforcement, which is another key element that comes together with increased ownership, and that could pave the way for the design of multi-annual fiscal frameworks. When we talk about credible debt reduction strategies, we should also take into account that there should be political feasibility in terms of political economy. And a commitment-based approach is a way forward also in this regard. My last point is related to the fact that this will not be the last crisis. Of course, others will inevitably come in the future. So we need to be better prepared by strengthening the stabilization role of national policies, but also by strengthening the architecture of the economic and monetary union going forward. So let me conclude and close my introductory remarks on a positive note, if I may, setting the stage also for the very interesting debates that will take place today. The pandemic has required unprecedented solutions to our common problems. And once again, it is clear that more Europe brings better solutions to our citizens. We collectively have to ensure that the recovery process is a success, increasing potential growth, creating good quality jobs, and aiming at more sustainable and inclusive growth models. We also need to design the right future-proof, bulletproof as well framework to finance the necessary public investments and implement the necessary reforms aligned with our shared priorities. In other words, we need to get it right with the recovery like we did it with the response to the pandemic. And as we enter the new economic cycle, the EU must grasp this opportunity to design a renewed, bulletproof framework of rules that will provide a horizon of confidence and hope for younger generations. This new phase provides a window of opportunity where we need to maintain a constructive attitude and break the old divides that characterized previous discussions. We should incorporate the lessons from the crisis and look to the future, focusing on those areas of common interest where consensus is actually within our reach. I look forward to a fruitful discussion and thought-provoking ideas as well. Thank you very much.
Thank you, Carlos. That was a great keynote introduction to the field from the Spanish perspective. Unfortunately, we have only 1 minute left for a discussion. It could be maybe if we have one short intervention from someone here, we could take that. Otherwise, I would like to ask you just one question, a simple question, whether you think how or when and how the SGP reform will take place. What would be the probable key reform? Will we have, I mean, how to have a credible debt reduction as well as filling the investment gap? Will we have exceptions for investment? You think this is realistic?
That's a twofold question in a sense. So on the timing, I think, as I said in the intervention, that the timing is essential here, and particularly taking into account those common areas of interest, we should take that as a starting point in order to build consensus, and this somehow should be done as soon as we can, in the sense of avoiding transitory solutions that last for too long. I think this is also important in order to give a signal of stability going forward in terms of the renewal of the framework. And on the specific solutions on how to incorporate, let's say, these two elements, let's say the growth friendliness of the consolidation and take into account also in investment needs, I think there are many possibilities to incorporate it. What is important at this stage is that we agree, let's say, on the common message, on the fact that we have to do as much consolidation as we can, and defining as much as we can has to do with the fact that the consolidation should not hamper or jeopardize the recovery in the short term, and it has to be also taken into account political feasibility elements. So we have to take into account country specificities to the extent possible, and also diverging starting points. I think those issues are also part of the debate, and I guess they will also be part of the discussion today.
Thank you. I think this is fine. For not to take too much time from the session one, I will hand over to Daniel Gross, who will chair the session one. Thank you.
Thank you very much, also State Secretary, for this introduction. When listening to you, I was struck by the introduction, which said that this time is different. And then you said we should avoid the errors of the past. Are we not making the error that we are fighting the last war? That is what I'm asking myself, and that is a question which I also would like to put to the three panelists which we have right now. I know that you have some prepared remarks, but if you could reflect on this, how to say, discrepancy between seeing that this time, this recession is very different, and then saying, but we have to apply the lessons from the past. Maybe we don't have to apply them because this time is different. But of course, the next session will be much larger. It will be about the economics of fiscal rules and debt sustainability. And you have seen that we have a very nice and diverse panel. I will not give long introductions because you all know the people who will be speaking. I hope they can stick to about 10 minutes each. And without further ado, I would like to give the floor to Klaus Regling, who is the Managing Director of the European Stability Mechanism. Klaus, the micro is yours now.
Yes, thank you very much. I hope you can hear me. I think my camera has still problems focusing on me, but we will fix that. No, thank you very much for inviting me. I think Carlos sets the scene very nicely, and therefore I can skip some of my prepared remarks. But maybe I start with your overriding question: is this time different? I think in a certain sense, it's very different from the Euro crisis, or what some people call the sovereign debt crisis. I prefer to call it Euro crisis because sovereign debt crisis just is way too narrow. For me, the key problem 10, 12 years ago was that several member states of the Euro area had lost competitiveness. There were macroeconomic imbalances that followed from that. One could see them in the current account deficits and fiscal deficits, but mainly looking at unit labor costs, which had moved totally out of line with the rest of the Euro area. And these developments had happened during what some people call the Great Moderation, basically the first decade of monetary union. Those imbalances had to be fixed. And that made the required policy response very different from the policy response that we have seen the last year and a half. Because this time, when COVID hit, there were no macroeconomic imbalances that needed to be fixed. And therefore, we could have a very different policy response. I think we had the right policy response this time, a policy response that would not have worked 10, 12 years ago. So in that sense, it is different. And we did all the right things the last 18 months. And Carlos talked about that, but I think we have to be aware that 10, 12 years ago, we needed something else, at least for the countries that lost market access, that had these massive macroeconomic imbalances. They needed to be fixed. And to the extent that they were driven by loss in competitiveness, which was the result of incomes, wages, salaries, pensions growing much faster than productivity, there had to be a drop in real income, which is always painful, but it was unavoidable at the time. Last 2 years, nothing like that. We had a good response. It was very important that the European level came in and provided particular help to those countries most affected by the pandemic. I think that was crucial. And that was always the intention when we had the early discussions in the Eurogroup last year in March and April. So we deliberately designed these several support mechanisms with that feature that countries most affected by COVID would receive more help, that we can see in the design of Next Generation EU. It's in the design of the ESM's pandemic crisis support, which is a precautionary arrangement, has not been activated, but the design feature was there. And it's also in the support, the additional support coming from the European Investment Bank. And I think that was very important because this really helps monetary union and the single market to work better, because this targeted support makes sure that we don't have excessive divergences within the monetary union. So I think that's what we try to achieve, and I think we are getting there. So all that was good. However, as we all know, and Carlos also mentioned it, the higher deficits that countries rightly experienced during the pandemic and are still experiencing, coupled with a lower GDP, with a drop in GDP last year, of course, pushed up the debt to GDP ratios. It was unavoidable, but now we are there. For the euro area, on average, the ratio debt to GDP has reached almost 100%, 15 percentage points more than before the pandemic. And given that we already had quite a variety of debt situations among the 19 euro area member states, now we see that some countries are significantly above the average euro area ratio, debt to GDP ratio. Nevertheless, looking at all countries, our judgment at the ESM, and I think that's shared by other European institutions, is that debt is at the moment sustainable in all member states. I think that's an important statement. I see you smiling, so you can tell us later why you are smiling now. But that's our judgment. And let me explain a little bit why we come to this judgment. The main reason is that we see this long-term secular decline in interest rates during the last few decades. And that has increased the capacity of countries to service their debt. This decline in interest, and we see it in the interest burden in the budgets of all our member states, because they have a much smaller burden in terms of GDP than 10, 20, 30 years ago, despite the fact that debt levels have gone up significantly in recent years. And that's a phenomenon that we see in all euro area countries, but we basically see it in all advanced economies around the globe, and even in many, but not all, emerging market economies. And of course, I also assume that interest rates will increase from today's very low level eventually. I will not make any predictions when, but they will increase. But economic research, I think, is pretty clear that the equilibrium real interest rate will remain lower for the foreseeable future than it was 20 or 30 years ago, for instance, at the time the Maastricht Treaty was negotiated. And the reasons underpinning this phenomenon, I think, are also clear from the research. It's aging with a higher savings rate. For that, it's the worsening income and wealth inequality. And we know that rich people save more, as well as lower productivity growth. And of course, we can hope, and we should hope, that stronger productivity growth with the right reforms may become possible one day. Let's hope that. But the other factors, aging, will not disappear. It's quite the contrary. Aging, demographic changes in Europe will intensify over the coming decades. And I also think wealth inequality is very, very hard to reverse. That's why I think it's a fair assumption that this long-term secular decline in real equilibrium interest rates will not all of a sudden be reversed, even though interest rates will not stay at this very low level. Having said that, it does not mean that money doesn't matter and that there are no budget constraints. I think we have to be quite cautious, and governments must be aware, particularly those governments in those countries where the debt ratio is clearly above the euro area average, that there are in the future some additional fiscal burdens coming up. And I see 4 of those additional burdens one should keep in mind. First, some of the debt accumulated recently by households and corporates may end up as public debt, particularly in light of the sizable government guarantees that were provided during the pandemic. Second, the longer-term cost of climate change and aging means extra cost for pensions and healthcare. They are typically not accounted for in the standard debt sustainability analysis, but these costs will come. Third, as I said, interest rates will go up, and from today's level, even though I repeat not to back to the old levels, but when they go up, of course, the interest burden will go up. Not immediately, because many countries have managed to increase the maturity of their debt issuance, but it will show up eventually. And fourth, a point that also Carlos rightly made, every country should create fiscal space to be able to react to the next crisis. We don't know when it will happen, but we know it will happen one day. And we saw early last year how quickly a lot of fiscal space is needed then. So even if interest rates, in particular real rates, remain well below the level of 30 years ago, the high debt ratios should be brought down to reasonable levels. Now, the best way, of course, for society to reduce high debt ratios is to increase the denominator. That means boosting growth. And that can happen through structural reforms, more public investment, and that is what is currently supported through the Next Generation EU package with a lot of money. And I think that's a very, very good approach. But it can also be supported through making revenue, the revenue side of the budget and the expenditure side of the budget more growth friendly. That's easy to say, not easy to do. What does all this mean then for the reform of the Stability and Growth Pact? And I know that the next panel will go into much more detail on that, but let me also make a few remarks. My first point is that fiscal rules remain necessary for the effective functioning of monetary union. That has been my conviction since the 90s, and I think it remains true. But it's also clear to me that we need an improved, simpler, and more credible budgetary surveillance framework that also reflects today's circumstances. Some of the elements of the SGP needed reforms already before the pandemic, like the non-transparent application of many exceptions, but also the use of variables that are unobservable and difficult to calculate, like the output gap and the structural balances. So all that was already known 2 years ago. The reformed SGP should also take into account the structural challenges faced by European economies. Using debt to finance productive public investment will be important for carrying out the green transition and the digital transformation projects which will shape the fabric of Europe's economy for decades to come. But, and that's my important last point, we should not overburden the fiscal framework. Maintaining debt sustainability must remain the main policy objective, in my view. We have other coordination mechanisms and policy tools like the European semester, country-specific recommendations, the EU budget, and EIB loans that can also be used to support higher growth and to finance the transformation of the economies towards green and digital. So not everything needs or can be done via the Stability and Growth Pact. We do have other instruments, and economists typically believe that for one objective you need one instrument. So let's not overburden, and let's not forget that there are these other instruments which are also important for the conduct of fiscal policy in the monetary union. So I'm looking forward to our discussion and maybe even more to the discussion in the next panel. Thank you very much.
Thanks a lot, Klaus. Sorry when I was smiling when you talked about
that's okay. That's what we are normally missing when we have these virtual webinars. If we meet in person, we have a lot more of that.
Yeah, and you have zero interest rates. Any level of debt is sustainable. I appreciate the remarks you made about equilibrium real interest rates likely to remain very low. I was wondering, because that research applies to the safe interest rates, right? And the question is, what happens if you have a return of risk aversion? Then things could become a bit more complicated, but we can discuss that later. You also, and I wanted to encourage Carlos if he has time, because I know these are very trying times for anybody dealing with a budget in Spain. If he has any remark or comment to make, he can come in any time. I wanted to now give the floor to Philippa Siegel-Klöckner. She's the director of the Dezernat Zukunft, which here says Munich, but I presume it exists more in the cyberspace than in Munich. Philippa, the floor is yours, and if you could address a little bit the issue which I mentioned at the beginning, plus something which Klaus and Carlos both mentioned, which actually everybody says. We should, there's a big need for additional investment. I'm asking myself, if I look at the numbers for countries, let's say Germany or also Spain, how much of the additional debt is actually coming from additional infrastructure investment? Is that a very large part? Philippa, the floor is yours.
Okay, so I hope you can hear me well. Unfortunately, my headphones just gave up. Otherwise, we'll have to try and find another solution. It's pretty challenging what you said as topic of the conversation. I think talking about debt sustainability, which requires kind of a long-term view, the crisis, how does all apply to rules, and then linking it back to what you just said, and then also I think what Carlos and Klaus said was very interesting, but I'll try and address a little bit of all and stick within 10 minutes. Can I share my slides? How do I do that?
You should be able to do so.
So,
we see your screen.
Perfect. And I'll try and make it full screen.
Perfect.
All right, perfect. So what I will try and do is step back a little bit from the immediate crisis and talk a little bit about parameters for debt sustainability in our current situation. And, you know, maybe we can get to some implications for rules and also the broader institutional environment, because as Klaus said, it's not just fiscal rules, there's a lot beyond that. And we probably have to think about those together. So my hope would be that by the end, we have some parameters for how to think about rules, and maybe that's a good kind of set of point for discussion in the next session. So first of all, I mean, I guess this is common knowledge by now, but I think we are in an intellectually challenging situation because the parameters that we have in the past don't really tell us very much anymore about debt sustainability. So what I'm showing you here, this actually Eurozone is debt versus interest payments in proportion to GDP. This is from Amico, so also going forward. And what we see is, yes, increasing debt levels, but interest payments going down, still on a declining slope. Even if we have a reversal in interest rates, that won't immediately reverse that trend, since maturity in the Eurozone, I don't know what it is off the top of my head, but I mean, when you look at countries, it's always somewhere in the range of 7 years. So that trend will continue for a while. So what does that mean? How do we think about debt sustainability in the medium term? Well, the first obvious challenge, and I mean, I'm looking at this obviously with a bit of a German perspective, but it applies to Europe as a whole, is aging. That's obviously the massive challenge, and actually that was a challenge before the crisis, and I think that's a challenge now, because we don't have a particular financial challenge, that we have huge debt service, at least overall. I get into that a bit more later, but the definite challenge right now that we have been facing for a while and we'll continue to face is aging. Now, I mean, especially talking from a German perspective, that doesn't mean that tomorrow we have a huge immediate issue. But when you look at the right side, what I'm showing you here is the subsidy going to the public pension system as a share of the budget, and then to give a comparison, interest payments. So yeah, at the moment, our fiscal rule, German fiscal rule focuses on minimizing interest payments in a way by minimizing deficit. But really the huge challenge is that a third of our budget, or close to a third of our budget, is already going to the pension system, and all our societies are aging further. So I think that's really, for me, what the big question for sustainability is. And then the question is, are we prepared for this? Especially, you know, given the crisis, okay, we didn't have as much of a shock to real output as we had with the financial crisis and the broader European crisis, but still, are we going to go back to levels of output that we had before? On the left side, you see the challenge. People have a longer and longer time between the end of their work life and expected end of their life at the time that we have to pay for. And when you look at working hours, and I did this as a comparison to total population, we're still actually below pre-financial crisis trend. So, you know, are we really set up for this? And I have a big question there, because even if the crisis now wasn't particularly harmful in the long term, we may have to try even harder. So, and then secondly, I'm coming to a different topic. Even if I say at the beginning, well, I don't think we have a particular challenge with the interest environment right now, and it's quite benign, I think what we shouldn't overlook, and I mean, Carlos and Klaus mentioned this both, is we just do have high legacy debt levels in countries. And that does mean that interest payments, even if interest rates are low, interest payments, a share of the budget, are quite demanding in some countries. I think what makes it particularly challenging is that this is a very different situation in different countries, the Eurozone. So while in Germany, Netherlands, is definitely not the case. And, you know, even if you have a shock, that won't immediately hit us hard. you already have an existing problem that just makes it very, very demanding for some countries to free up enough fiscal space to do all the productive investments and productive spending that is required. So I think when we think about sustainability, we need to think about that legacy issue and what to do with it. So then another question, so this was interesting because Klaus raised that quite a few times, is that interest levels are low, but they may change. This is a very recent paper. I think it came out a couple of days ago from Sebastian Hillenbrand, who showed for the US that actually decline of interest rates can be explained largely by Fed meetings. So, and then his conclusion is, I mean, when he digs deeper, that this is because the Fed has special information about the long-term equilibrium interest rate. But I mean, it puts a big question mark behind, this is also independent from the central bank. Now in the description for our panel today, you just said, well, what happens when the central bank withdraws support? So I think for me, there's a question of, can we think about sustainability even without, explicitly thinking about how the central bank behaves, and what does it mean if the central bank withdraws support? Does it just mean, ending the PEP? Will they, how much will they actually look at interest rates at spreads, especially if the link is quite strong? Now this is US, but I think it's something that we may have to keep at the back of our minds, especially when in some countries we do have quite high debt levels. Then, and this is really for me, I think the really hard question about debt sustainability. I mean, all the things we talk about are in the end very long-term developments. And then when you read the paper by Furman and Summers on reconsideration of fiscal policy in the era of low interest rates, I mean, what they basically say is, well, look, it's all very nice that we talk about debt sustainability, but we can't really say anything beyond 10 years. But especially, when we think about the aging question, I mean, this is one that's really, I think, 10 years and beyond. And they try and make the point by showing this chart where they project US debt levels forward. And basically they say, we can only say with a 2/3 probability that in 2050, debt in the US will be between 66 and 157% of GDP. I mean, that's basically a non-statement. None of them will be, that wouldn't be very helpful for policymakers as a guidance. So I even wonder how much can we say about sustainability as a kind of point estimate, and can we just reason about it in a sensible way today? And that's the best we can do. So that brings me to, how do we think about this and what are the parameters? I really like the definition of debt sustainability in the new IMF DSA that was released for market access countries at the beginning of this year, I believe, where they basically focus on the primary balance that can be achieved economically and politically. And this goes to Carlos' point about, it also needs to be politically feasible. And then I think the rollover risk is actually nice that they enter this. So it's not just about solvency in the long term, but liquidity in the short term, which to a currency area like the euro area, that's actually quite relevant, although we've probably hopefully mitigated that issue a little bit. And then finally, they include potential growth, which I think, when we look at the longer term and we try to think about it, even if we can't project it, is a key question. Where does this leave me? How do we operationalize this to think about rules? I think we can think about a couple of necessary criteria that need to be fulfilled to have that sustainability in the future. So first of all, there needs to be no unreasonable financing effort required. So I think as a sanity check, we can look at, was there historical precedent for achieving growth, because most of our countries will need growth under the fiscal effort that is currently required to achieve a sense of a balance. And so if countries require a huge primary surplus because of their financing requirements, that we probably need to think about whether this can actually work. Secondly, if the financing side is okay, I think we need to look at drivers of the primary balance, and there this issue of aging is the big one. And is potential growth sufficient, even if you can't define potential, but to deal with the demographic trends? And then finally, is rollover risk sufficiently mitigated through a politically feasible agreement? And how do we incorporate into our thinking that the central bank may play quite a big role? I would say there is a way that they can even be linked to a central bank mandate, because they need to preserve the financing conditions adequate for achieving their mandate. Obviously, if we have a massive lack of growth, very cool economic environment, we won't achieve close to 2% of inflation. But it's a tricky one how we think about that linked to fiscal policy, also because of the political implications. These are a couple of points I think we should consider, and I'll stop here.
Thanks a lot, Philippa, also for sticking to the time. What Summer says, I think, means basically, if you are flexible enough, you don't have to do something today because you're fearing something will happen in 10 years. But I think that if you are flexible enough, that is one of the key conditions for their statement. If you could stop sharing your screen. And we now come to our third contributor. Roel Betsma is a member of the European Fiscal Board and professor of macroeconomics at the University of Amsterdam. Roel, the floor is yours.
Yeah, thank you, Daniel. Just briefly coming back to the question, is this time different? I think we are better prepared. Countries have access to the capital markets, but the crisis is also not yet over. In the Netherlands, my country, we went into a lockdown, and well, we'll need to see how long that this will last. So let me share the screen. Now I need to find, yes, okay, I think, can I do that? Yes, I suppose you can see that.
Yes.
Okay, so some weeks ago, the European Commission relaunched its economic governance review, and I think that is a good thing. As a European Fiscal Board, we remain of the view that it is important to reform the current fiscal framework, and we are very happy that the Commission wants to build consensus in time before the general escape clause is lifted, most likely the beginning of 2023. And we believe that a reform of the rules would benefit both the member states that are worried about erosion of the rules-based system. So, for example, some of the northwestern countries, but also the countries that have in the past used the flexibility of the Stability and Growth Pact. So both groups would be, in our view, would be well served by a revision of the rules. And in any case, if the revision makes fiscal policies more predictable, then that is, of course, reassuring to the financial markets. Now, we already talked quite a lot about fiscal sustainability. And it is, of course, true that debt servicing costs have been falling, and they may fall further. But interest rates may also go up, and that was pointed out by Mr. Redling, that they at some point they will go up. And of course, there's a lot of uncertainty, and the financial markets, they don't really price that in at the moment, but we also know that financial markets are sometimes, mistaken. I think, Daniel, you pointed out rightly so, we've seen a fall in the safe interest rate. And maybe it will fall further, but I could also see, and of course there's a lot of uncertainty, that For example, the huge investment burden, climate investment will actually change the investment savings balance at the global level, and that it will, may push the safe interest rate up. And on top of that, of course, there are risk premia that can change. So we believe that debt reduction is very important, and especially for the very high debt countries. So if you look at the graph here, you see since the 70s, it's in a way, it's like there is a ratcheting effect in the public debt ratios. Each time, each crisis, the public debt becomes a little bit higher. And when we look at in more detail at the period since the start of the euro, we see that, we see three country groups, and especially the countries with very high debt levels, they also experienced the biggest rise since the global financial crisis, and again since the start of the corona crisis. So it is important that countries with very high debt levels, that they reduce their public debt to protect against the future crisis, which will no doubt come, but also against the possibility of rising interest rates, which we cannot be certain about that will not happen. As European Fiscal Board, we share a lot of the diagnosis by others, but and by Olivier Blanchard and his co-authors, but we don't believe that fiscal standards are the right way to go forward. Also, there is the question within the current framework, should reference values in the treaty be revised? We are somewhat skeptical about this. The EFB's agenda for update and simplification is shaped by the pre-pandemic experience, excessive short-term focus, reliance on unobservable indicators, poor compliance, and backloading of fiscal adjustment. Before the pandemic, we made proposals, but we believe that the pandemic has actually made our proposals even more relevant. And so the proposed reform is to set numerical targets for debt reduction in countries, though given the reality of very different debt levels and debt levels that are very high in some countries, we would argue in favor of a moderated and differentiated pace of debt reduction. Now, the debt target would be achieved via a single observable indicator, an expenditure benchmark. Basically, expenditure would grow in line with potential output, with a correction for the need to reduce the public debt. And we argue in favor of doing away with all the various clauses in the framework, the flexibility, by just having one escape clause, and the escape clause would be invoked on the basis of independent economic analysis and advice. Now, the 3% threshold, it's in the annex to the treaty. We believe that it should remain as a backstop, and in any case, it will be difficult to change. Now, a few words on the initiatives in 2020, the Recovery Fund and SURE. We believe they have been fulfilling a very important role, but of course, they are temporary, and if we think of the longer run, it is, in our view, necessary to finance EU common goods, to have also common financing of especially investments that have cross-border positive spillovers. now the current recovery fund basically consists of national plans that are in a way a somewhat arbitrary configuration in the end. And they are not so much focused on those type of investments that have common benefits, like upgrading of electricity grid works, networks, hydrogen investment, etc. And what is, of course, needed is some capacity for macroeconomic stabilization. Now, I think it is important to think about this as soon as possible, because the current recovery plans, of course, they will run out in a number of years. So one possibility that has been proposed by the European Fiscal Board would be to create within the EU budget national envelopes that countries could make use of for investment, and if they don't use it, it would just, the remaining resources would become part of the general EU budget. We believe that it is important to have a proper balance between national ownership and EU perspectives. And this brings me also to the role of the independent fiscal institutions. They will play an increasingly useful role in EU fiscal surveillance. So, for example, when it comes to monitoring debt developments. But then, on the other hand, there are also limits to decentralization in the monitoring of the fiscal rules. So the Commission and also the Council, they will keep a very important role. As we know that the IFIs, they are very different. They have different amounts of resources. In effect, they may differ in terms of independence, etc. And so it will still be an important role for the central level. So thank you, and let me hand back.
Thank you very much. And thanks to all three of you also for sticking to the time, so we have some room for interaction between the panelists themselves. I don't know whether there's anything immediate either Klaus or Philippa would like to say about the other co-panelists. And I'm of course willing, for the audience, I'm also willing to entertain questions which you can put in the question and answer session or in the chat, please. But either Klaus or Philippa, anything you would like to react to?
Well, if you ask me, it's more on the questions that you raised at the end of my intervention. You raised some doubts whether that sustainability could be assured in the long run, because maybe only for safe assets, only for reserve currency issuers, while otherwise, when risk aversion comes back, you probably implied that spreads would go up a lot. So that, of course, is a very interesting question. It seems there's a very fairly broad agreement that the real equilibrium interest rates for highly rated countries has come down and will probably stay at a low level, not as low as today, but at a low level for quite a while. So what could happen to the spreads? And that's a relevant issue for the monetary union, of course. It's not a relevant question for the United States or for Switzerland or Japan. But here I would argue that all countries in the monetary union would benefit first from the lower level. It is lower than it was 30 years ago. So whatever happens to spreads, the spreads come on top of a lower level. But then, and this is more an analytical question, but it's my judgment that with the experience we have gained after the euro crisis and the experience markets have gained, I think the risks that spreads become excessively large, like they were unreasonably large, like they happened in 2010, 11, 12, that risk is much, much lower today. because of all the measures and steps taken over the last decade, the institutional improvements, begin of banking union, for instance, if there are problems with large banks, it will not only be a national problem, to some extent at least, then Europe would step in. So the fiscal burden for one country would be less. So this doom loop, which is still there to some extent, would be less than 10 years ago. We do have the ESM, and we know what the ECB is prepared to do. Or in a very general sense, I think markets have very much learned, often in a very costly way for those who didn't believe it, that the countries are supporting the monetary union, all of them. Because whenever it became difficult, they stepped in with different measures, first creating the ESM, EFSF, creating banking union, the ECB was there. And markets have internalized that because they learned that those market participants who believed that the euro would be protected made a lot of money in the early years of the last decade. And the others who were betting against governments and the ECB lost a lot of money. And this, I think, is a valuable lesson that will also make sure that spreads will not become as unreasonable as they used to be. Looking at from a different perspective, I think all euro area member states benefit from the fact that the euro is a reserve currency. Just imagine what would have happened to a Greek currency if it were called drachma again, if Greece had left the monetary union in 2015, which was very close, then they would have a very, very different environment. The fact that they are inside the monetary union, they benefit from the situation that the euro is a reserve currency, and that will keep the spreads also for countries with high debt levels much lower than in the past.
Thanks a lot for these considerations. So I take it that you expect the risk premium to remain reasonable. Whether reasonable is enough to ensure the sustainability. And maybe I see Philippa has her hand raised, so I will give her the floor. Just one argument which maybe you and other people can ponder over. During the euro crisis, for Greece, the question was always, or not always, by many people linked default and remaining in the euro area, although Greece de facto defaulted and still remained within the euro area. Could we not think about a future regime in which countries can default, but still stay in the euro area? After all, in the 1840s, we had several states of the United States defaulting, and they stayed within the dollar zone as it existed at the time. So is there really a need to link membership in the euro area with state solvency, especially when we have a banking union and can take care of banks at the European level, not necessarily the national level? Perhaps before you answer Klaus first, Philippa.
So briefly on your earlier question and also on the RRF, and then I'll try and answer that. So on the RRF, I mean, I couldn't agree more that I think we should think about future instruments and what to do, because I think as became clear from my presentation, I believe we have a problem with fiscal space in some countries to do necessary investments for the future. I mean, I mainly talked about aging. I haven't even talked about climate properly. I do see now a bit closer how expensive it is to transform an economy, looking at the German budget. I mean, maybe we also do it in a more expensive way than necessary. But even if you are a little bit stingier, it requires a lot. I mean, even if you don't talk about industry subsidies, but you know, just the necessary public infrastructure and the shift in the economy, it just costs a lot of money. So I do doubt that, you know, currently we do have the existing space to do this. My worry is that I think that is a bit of a red flag currently here in Germany. We're very, very cautious to talk about further build-out of common instruments or anything to address legacy debt. So that, for me, is just a problem at the moment where I don't have an answer to. To your question on default, I mean, essentially, if you do that anyway, whether with an exit of the currency area or not, I mean, you basically make sovereign debt more like private debt, which I think is completely fine as long as you have sovereign debt somewhere. If you completely rid yourself of that instrument, I have my doubts whether that's a good idea. It's pretty helpful instrument to have. So I think that's very much linked to my first comment on how much of a shared instrument you have, and if you have that, then could you have default at that level? Probably, yeah, but it requires a lot more of a common instrument than what we have at the moment. And I think that's also where the comparison to the US or German lender is not quite right at the moment, because you don't have that sovereign built over.
In the US, most federal debt had been repaid by the time they had these local defaults. Royal, you have raised the hand. Can I just ask you a more technical question? In the one chart which you showed, the different groups and their debt levels, it looked to me as if the high debt group showed a non-stationary line. So if it's non-stationary, it means sooner or later it's going out of bounds, and I would call that not sustainable. So something must be done to change that time path.
Oh, well, okay, thank you, Daniel. Well, I'm not going to say that the debt of these countries is not sustainable, but of course the risks to sustainability, they seem to increase with each crisis. So I think it's very important to build down the debt and in order to have buffers for future crises. On your question, I don't see a debt default directly one-to-one linked with euro area membership continued, or whether a country would need to leave the euro, which of course legally is not possible without leaving the EU. I think in both cases, if it is a large country, especially, there will be a lot of damage inflicted. Whether the country would leave the EU, leave the euro or not. That said, I think it would be important to have in orderly debt restructuring, infrastructure, because I think that moral hazard has been downplayed, quite a bit, but the signals from the financial markets, I think, are important to discipline governments. But I don't think, I don't think there's a danger now, but if default would happen, then it has big consequences. It has big consequences for the banking sector, and I think in the end also, despite the fact that debt will be written down, there would still be support needed from other countries. So it would be a very costly process. Thank you.
Nobody said it would be costless, but the question is whether the two are linked, right? That is the key issue. I repeat, we already had one default, right? Which was incredibly messy and brought us to the brink of political and other disaster.
Yeah. Of a relatively small country. So, you can imagine what happens if it is a much bigger country.
Thanks. Sorry. Klaus, you have been very patient.
Yeah, no, that's fine. And very happy to listen, and I can continue where Ro left it. I also wanted to talk about that point. I fully agree with him. It would be very, very costly. And I don't think it's reasonable at all to compare the world today with the United States in 1840, 180 years ago. Probably at that time, capital financial markets maybe were, 20-30% of GDP. Today, we know it's 300 to 400% of GDP. And particular countries that are part of a monetary union, they are linked through capital flows so intensely to the other members of the monetary union. We learned that very clearly during the euro crisis, particularly a country like Greece, needed so much support, more support than any country has ever received in world history from its friends. The ESM alone provided 100% of Greek GDP in financing to Greece at very, very low cost. Plus there was some IMF financing, some financing from the Commission. So that was needed in order to avoid the defaults. Then there was, of course, the debt write-down with private creditors, the biggest write-down in history. And the Greek government defaulted via the IMF for 1 week before we stepped in and provided financing to correct that. And it was already a bad situation for the Greek economy. So to have that as something, as a mechanism with which the monetary union should live in the future, I don't find that a very efficient solution. I think it's much better we learn the lesson from what went wrong during the first decade of monetary union, where year after year, massive macroeconomic imbalances accumulated. I think this is unlikely to happen again anytime soon. It was not at all part of the crisis the last 2 years, because defaults are very costly. I think we have better ways to prevent that.
Thanks a lot, Klaus. There is one question which is for you and perhaps made for you in the chat, which I read out. What would be a reasonable level of public debt? Is the 60% debt to GDP rule still viable?
Well, I didn't mention the number, but I tried to argue why today the debt carrying capacity of sovereigns is higher than 30 years ago. 30 years ago, when Maastricht was negotiated, I think one can find reasons why 60% was adopted as the debt ratio that would govern the entry into monetary union. And at the time, it was probably not unreasonable. You can always argue it could be 5-10 percentage points higher or lower, but it was not unreasonable given the circumstances at the time, nominal growth, average equilibrium interest rates. Let's assume for a moment the 60% was the right decision 30 years ago. Then I would argue today it's no longer the right number. I think today, given what we know, it can be higher. And again, there's not one scientific way to say it must be 100% or 90 or 105. But I think there's clear evidence that it can be higher than 35 years ago when Maastricht was negotiated. It does not mean, and I think the different speakers agreed on that it's now a carte blanche and every country should just spend. And the different charts we saw from Roll, for instance, are very clear. And we also saw there that a small group of countries have debt ratios that are clearly above today's average of 100%. And I think they, for the different reasons I mentioned earlier, should do something about it. But what would not be reasonable, neither politically nor economically, to apply today's rule and say, for instance, Italy should move from 160% debt to GDP ratio today to 60% within 20 years. And that's what today's rules would require. I think that we need to look at because a higher debt carrying capacity is there for countries.
Thanks a lot. I cannot resist just saying that I really disagree on this point, because at least over the next few years, the nominal growth rate will be so high that Italy can very easily fulfill the 1/20th. It's not in 20 years, it's 1/20th of the difference every year. And given the growth rates we expect, or the Commission expects over the next 4 years, that would be very easy to achieve.
Well, sorry, I have to respond to that. I think, and we had an exchange of mails on that. This is only true for the next 2 or 3 years, while Italy, like other countries, are catching up. It's not a solution for the long term.
Entirely, that's what I said. Only for the next few years. Okay, I wanted to finish.
That does not take Italy then to 60%. So I think one has to look at it.
I just wanted to finish on investment, which is very often mentioned also as a key issue. And perhaps first to Roel and then finish with Philippa. And the question to Roel is, I thought I understood you correctly that you would not make an exception for investment spending. And from Philippa, I would like to know, how much would it matter for Germany? Maybe the Schuldenbremse would no longer would be difficult, but how much would it add to the deficit, ceteris paribus, if these investment plans were to be implemented, right? But first, Roel.
Yeah, that on investment, a lot of people have been arguing for investment or golden rules, etc. We are kind of skeptical about this because we know that as soon as you make an exception for investment, then of course governments are trying to classify other spending as investment. And so we are more of the view that provide financing for investment from the central level through, for example, a national envelope in the bigger budget that can be used by countries to stimulate investment.
Thanks a lot. Philippa, the last word is yours. Very briefly on the feasibility of an investment rule and exempting that from expenditures. I think that's incredibly difficult to do because in Germany it requires changing the constitution. So if that's off the table, a German finance minister essentially has to say, well, the European rules are softer than the German ones. That, I think, politically is very, very tricky. Now, you asked a slightly different question. If I understood you correctly, the question was, if the investment that we tried to make happen with the coalition agreement materializes, how much of an impact does it have? So very, very hard to say because lots of ifs and thens. I mean, basically the mechanism is you use the emergency clause to, get stash away some credit and then use it in future years. If we don't have a huge increase of expenditures towards the end of this year because we have a lockdown, and if they take on the debt as projected for next year, which will be about 100 billion, you assume that they take around half of that to stash it away, then for 2023 to 25, you'd get around 40 billion. So that leaves you with a deficit of like 1.1, which is quite a bit larger than with the debt break, which is 0.35 plus cyclically adjusted. And I mean, at the moment, projection is that the economy is at or over capacity at 23. So it wouldn't be much larger than 0.35. So it would make a substantial difference for Germany.
Thanks a lot. I take it then about 1 percentage point of GDP in addition to what would normally happen.
Yeah, roughly, I think.
I think this is important to keep in mind in this overall discussion of debt sustainability and fiscal policy. When you're talking about deficits of 5 to 6%, and the investment part is 1%, for Germany it's 1.7 versus 0.7. It's different. The relative importance, I think, of investment in influencing the overall fiscal balance is very different from between different countries.
Let me just add one caveat, because most of this money will not be investment by the standard definition. Most of this money will make electricity cheaper and be a consumptive expenditure. So just have to be careful on that.
Yes, thanks a lot. That is the difficulty we always have with this. And with only 4 minutes overtime, I think we can finish. And I want really to thank all three of you for this animated discussion. As you have noticed, I try to animate it, not to moderate it. And I hope I have succeeded. And again, many thanks for your time. And back to the organizers. Christian.
Thank you. Bye-bye.
Thank you, Daniel. Thank you, participants of session 1. Now we have a short break and we can keep online if we want to, but we can also wait until it's 3:40 when we go ahead with the next session 2, on the question, what type of fiscal rules exactly will the EU need? So looking forward to meet you in 5 minutes. Hello, Sebastian.
Hi there. How are you?
I'm fine.
Cool.
You?
Yeah.
We'll probably wait a minute.
Okay.
Good afternoon.
Bonjour.
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 Catherine.
Hey, Cynthia.
Hello, Sebastian.
All right, should we just start with the second session? I think everybody is there. Hello, everybody. Hello. So the next session is on what type of fiscal policy does the EU need, and we have a 1 hour budget. So let's try to give everybody 10 to 12 minutes for her or his presentation, and then later on discuss, as we have seen in the last session. Probably we can also pick up some of the interesting things we have heard in the last session. But now I don't want to use too much space. And who is the first speaker? Catherine, is that right? Then I will introduce you. Catherine, you are an economist or at the OFCE. You're also president of the AICE, Association of European Business Cycle Research Institutes, if I got that right. And I'm looking forward to hear your presentation.
Yes, thank you very much. I'm going to try to share my slides. So can you see the slides? Yes, all right. So, well, thank you very much for the kind invitation to give a presentation at your webinar on redesigning fiscal rules. I will start with saying that, well, the search for a satisfactory fiscal rule is the sort of concours d'épines, a race to innovation for economists. The COVID-19 crisis has obliged the European authorities to suspend fiscal treaties for 3 years now. We've seen with the crisis that there is a need to have strongly active fiscal policies. During the crisis, there were huge rises in public debts and deficits, with now public debts being above 100% of GDP in a number of Euro area member states. The experience from 2011-2012 has shown that it would be counterproductive to request member states to fulfill rapidly the existing fiscal rules, and that the 60% of GDP rule should be forgotten. The fiscal rules should not oblige member states to undertake restrictive policies if these are not needed. The fight against climate change requires strong public investment of around 2% of GDP per year, probably more, which would be facilitated by the current and probably future low interest rates levels. This investment will not be particularly growth friendly. Fiscal rules should not prevent the investments needed for the future. Do we need fiscal rules? Well, fiscal rules are constraints on fiscal policy. They impose or restrain a number of variables such as fiscal deficits, public debt, public expenditures, as was shown by the financial crisis or the COVID-19 crisis. Fiscal rules are very unlikely to account for all possible economic situations, hence fiscal rules cannot and should not be met in all circumstances. They must be reviewed, halted, or simply not met. Fiscal rules often aim at showing how fiscally serious governments are. They depart from the basic principle of functional finance, that is to say, public finances should not be managed for themselves, but for macroeconomic targets. Fiscal rules aim at reassuring financial markets, international institutions, or creditor country. They always show some degree of mistrust towards democratically elected national governments. And the simplest rules, such as the rules which we have, the numerical rules which we have in the euro area, are unlinked with macroeconomic situations, and they rely on arbitrary numbers. There has been some consensus among European institutions and European economists on what is called a public expenditure rule, according to which, public expenditure should grow less rapidly than the sum of inflation and potential GDP growth, with a view to bring the public debt down to the 60% of GDP target. There have been various proposals that differ on how to account for inflation, how to account for public investment, on the speed of convergence towards a debt objective, that objective being 60% of GDP or 90% of GDP, or with a moving target for some time period of 5 years, for instance. I will focus briefly on one of the first rules suggested by Claes Darvas and Leandro 5 years ago, a rule which would say nominal expenditure, public expenditure, excluding interest expenditure, labor market expenditure, one-off expenditure, and net public investment expenditure shall not rise more rapidly than medium-term potential growth plus the inflation target, reduced by 0.2 times the difference between the debt level in the previous years and the 60% of GDP debt criterion. When you try to make a simulation of such a rule, which I show in this table, with a country having at the beginning of the time period 100% of GDP debt ratio, public expenditure of around 50% of GDP, and an initial primary balance of minus 2% of GDP, well, you can see in that table that it will take 20 years for the country to bring its debt ratio from 100% of GDP to 60% of GDP. That will require huge cuts in public expenditure, bringing public expenditure from 50% of GDP to 43% of GDP at the end, and bringing the primary deficit of minus 1.6% of 2% at the beginning to a huge surplus. So this type of public expenditure rule means that there's going to be a lot of public expenditure cuts to be done. Can this really be done? That's a big question mark from my side. And also this type of rule doesn't say what you have to do once you reach the target. Once you have reached this 60% of GDP target, for instance. So there are really two main drawbacks in the public expenditure rules. There have been a number of other proposals which have been made and just mentioned earlier in that webinar. One is by Blanchard and Leandro and Zettelmeier, who earlier this year made the proposals of switching rules to standards in the European Fiscal Framework, which in my view makes sense. Blanchard and his co-authors said that the European Fiscal Framework should mainly be concerned with debt sustainability. They show that sustainability conditions have changed since the early 1980s, with now interest rates being significantly below the nominal growth rates. And they propose to abandon fiscal rules in favor of standards, that is to say, qualitative general principles. There are, however, in my view, some weaknesses in the proposals, in the standards proposals. One of them is that based on Blanchard and his co-authors' proposals, there would need to be a stochastic assessment, but it's very difficult to make a stochastic assessment. How to assess a probability of default in a situation of strong uncertainty? We have seen with the COVID-19 crisis that there was a huge rise in debt. There was ECB support and no doubt on the risk of defaults among euro area countries. So how to assess debt sustainability in case of common shock or in case of specific shock. And the other major problem, in my view, with these proposals by Blanchard and his co-authors is that it would be the role of either the Commission, the Council, or National Fiscal Council to judge whether the sustainability is on track, and with the possibility to have complaints by the European Court of Justice. So in my view, that's a big issue. Would a sovereign country accept to give a veto right especially to committee of experts or to the European Court of Justice? I will now move on to the view which I have developed with Henri Sterdignac, and we released today a paper, a working paper at OFSE. Well, in our view, a relatively satisfactory rule would be that a country should be allowed to run a structural public deficit equal to its net public investment. That's the golden rule of public finances. I know very well the difficulties to measure, especially investment, which kind of definition you give investment, how to account for education, research spending, green investment. These are big issues, of course. And one point also of the golden rules is that it should take account of the short-term stabilization measures which are needed in countries. So our view is that really in the euro area, member states should have at least the same possibility to run their fiscal policy than other advanced economies. They should be able to issue safe public bonds at an interest rate controlled by the ECB, and the public debt should be guaranteed by the ECB. Euro area member states should be allowed to run a government balance consistent with their macroeconomic needs. They should be requested to amend their fiscal policy only if there is evidence that their policy has negative spillovers on the other member states. The mutual guarantee of public debt should be entire for member states who agree to take part to an open coordination process. This coordination process should target growth, full employment, and environmental transition. Member states should present an economic policy strategy allowing to meet the inflation objective, allowing to rebalance disequilibrium in the euro area, where we know today that there are still large current account surpluses in some euro area countries, and these current account surpluses should be reduced with asking, for instance, the member states to finance explicitly projects, preferably industrial in deficit country. The coordination process should allow for autonomous but compatible fiscal policies. There should be a mechanism in the treaty to prevent the case where a country would not take part fairly to this open coordination process. And in this case, the newly issued public debt by the country would not be guaranteed anymore by the ECB. But this case should never occur. Where are we now? Well, we already mentioned it in the first part of the webinar. There have been several views expressed in the euro area at the ECOFIN meeting, for instance, with some countries tending to think that we should now move from the 60% of GDP rule to a higher debt criterion of maybe 100% of GDP. This would allow to require not to require member states to run too restrictive policies from 2023. Some member states consider that public investment should be withdrawn from the deficit rules with the issue of green investment, but also investment to increase potential growth and research and development expenditure. But there is a coalition of so-called frugal member states, according to which, well, it remains very important to keep the rules as they are. They are sound and they should be remained as they are, with debt reduction, which should remain a common target. So there is this consultation process, which has been now launched by the European Commission more than a month ago. It's a very ambitious agenda, which we have there, where I hope that among the economists, we will have all good proposals, but it's not an easy task. And there is a risk that finally there will be no political agreement reached to review the fiscal treaties, and so that rules would be implemented as they are enshrined in the treaties, but with flexibility. And finally, we would end with a kind of much ado about nothing. Thank you for your attention.
Thank you, Catherine. Great. Is there any short intervention at that moment? A question to Catherine? If not, we can go ahead with Sebastian Barnes. Sebastian is acting chair and founding member of the Irish Fiscal Council and represents a network of EU independent fiscal institutions today. Sebastian, thank you for being here. Hello.
Thanks very much. Thanks for inviting me to this actually very rich and timely discussion. It's something we've been thinking about a lot too. You can see my screen?
Yes.
Perfect. Okay, so thanks for that introduction. So what I want to present today is based on the report that came out last week from the network of EU independent fiscal institutions. So this is a grouping of the 32 IFIs in the European Union. You can read the report on this link. This report was prepared by a working group of the EU IFIs. It draws on actually the sort of unique perspective, I think, that the IFIs bring, that we're both very involved with national fiscal policy. We are also quite involved with the European rules in one way or another that interacts with the national rules. And of course, we're independent expert bodies. So unlike the governments, you can trust us. I should point out this doesn't necessarily represent the views of all of the members. It's produced by the network's leadership, but it does draw on that rich evidence base. So in terms of the overall design of the future fiscal framework, the report basically recommends an approach based on 3 pillars. And we believe these pillars are mutually reinforcing. The first one is continued reliance on the numerical fiscal rules. The second is an enhanced role for the IFIs. And the third one is improved data and other information for the process. Now, I guess some of the discussion here is really between a rules-based framework and one that involves discretion and judgment. I think where we come down is the fact that you need both of those things, and then they enhance each other. So you need to keep the rules, but we also think that IFIs have more to bring to this process. And one thing that's very important, I think, from the IFI's practical perspective is that really the new governance framework in some form needs to be in place from 2023. The general escape clause has been extremely helpful to deal with the pandemic. But we think going back to a system that's too heavily reliant on discretion could be very suboptimal and could make it very hard to move back to a more rules-based system at some point in the future. So there's an urgency to this. Going through each of those pillars individually, the network doesn't take a position on the exact setup of EU fiscal rules. It's a really complicated task to design a sensible set of rules that works well for all countries. It's also a lot of the discussion is based around very high-level principles, but actually our experience is that often the details of those rules is actually perhaps much more important than just which really high-level judgment you take. And getting the rules right is absolutely critical. And so what we set out in the paper is basically a sort of set of criteria, if you like, about what numerical rules should be like in the revised framework. And that's basically they should be simpler, they should be more transparent, they should be less pro-cyclical, both in what the rules imply, but also in the way the implementation works, and they should be genuinely multi-annual rules, which isn't really the case at the moment. In terms of the complexity of the rules, we think they should be addressed by reducing the number of rules that are the focus of enforcement. Maybe it's hard to get rid of the rules, all of them because of the sort of institutional framework, but the focus of enforcement should be on fewer rules. And there's a lot of scope to streamline the details of the existing rules. There's good complexity that you need because the world's a complex place, and there's bad complexity that just makes the world more complex. And there is a lot of bad complexity in the rules as they currently stand. In terms of one of the reasons why we're not particularly bothered about the high level design is that if you start from the high level of goal of fiscal sustainability and economic stabilization, I think you can work through various ways to what I think most people seem to view, and I think the network and IFIs view this as a good goal, to have as an operational goal a multi-year expenditure ceiling. So we basically are quite sympathetic to that proposal, but we're not particularly taking a view as to how you get there. One way is to have a debt reduction target. You can either set that by formula, or you can set it politically, which is maybe what Katrine had in mind, or you can have basically the current framework where you set it as the expenditure benchmark, where it's based on the medium-term objective, it's based on the structural budget balance, but actually the level of debt is also taken into account. So there are different ways of getting to this multi-annual expenditure ceiling. But then the key thing, once you've got there, is that you really need to design the multi-year ceiling in a kind of very good and a kind of smart way. And the most important thing is probably the first sub-bullet, which is that it really needs to become a genuine multi-annual spending path. At the moment, the public finance is very focused on a year-to-year developments, where really the public finances should be looking at the medium-term path. We know debt is a very medium-term story. We also know that climate change, aging, these are all factors that play out, not just in 1 year, but over multiple periods. So really the reform should aim to create this genuinely multi-annual framework. And the current rules don't really do that. So the expenditure benchmark partly because it starts from whatever last year's spending was, and also because it's based on a measure of potential that can move around quite a lot, keeps changing all the time. So it's not the medium-term anchor that it should be. So you really need a medium-term path set in terms of the level for the public finances a couple of years ahead. And there's a number of other things in terms of the way it's measured and whether you allow for deviations from the rule, perhaps for a rainy day fund, that also need to be addressed in whatever design people come up with. Two other issues around the rules, one which we've discussed a lot already this afternoon, is investment. Here, I think the view, there's quite a lot of different views amongst the IFIs, I'd say, but in general, there is some openness, I think, to giving it special treatment. But I think the advantages and drawbacks of that need to be very carefully weighed. I think sometimes the argument is essentially made, we need to do this investment, interest rates are low, therefore we should exempt it. And it's much more complicated than that, both I think in terms of the different sort of definitional issues, but also issues about how, for example, this borrowing would interact with the fact that maybe we need to get debt down in quite a few countries as well. So it's not that straightforward. And I think there's a lot of caution, I think, in our note about that. The final thing under the rules is that any set of rules should be tested properly prior to implementation. And that often hasn't happened in the past. People make kind of a priori reasoning for why one set of rules is better than another, but people don't test them adequately. But, you know, people should look at what it actually means based on the forecast now, but also consider the risks that we might find ourselves in a different situation. You should also do pseudo kind of real-time simulations. That would help to reveal some of the problems with instability in real time in some of the measures of potential, some of the problems we've had with the debt rule requiring a very strong front loading of adjustment would have been apparent had anyone done their homework at the time. So good testing, it's like any design thing, is essential. The second point is how can IFIs contribute to this process? How can these independent fiscal bodies contribute? Well, there's quite a lot of evidence in this area, you know, from academic research. IFIs can help to produce more accurate and better fiscal forecasts. It can improve monitoring and transparency, can reinforce compliance with the rules. It can help make the case for the public for sound fiscal policies. And I think that's one of the very important roles of IFIs. There's plenty to think that the IFIs have more to offer the process than they currently do. The big question is how that interacts with the European process. And our paper makes a strong call to strengthen the role of IFIs in the EU framework. In particular, it focuses on this first part, that there should be a requirement at EU level from the Commission, from the Council, to take into account the assessments of national IFIs. That doesn't mean the European institutions should do what the IFIs say. The European institutions need to make their own judgment, and I think the IFIs wouldn't want to be drawn too closely into this process. But it would codify what kind of happens already, which is the Commission does, I think, in practice, look quite a lot of the IFI reports, but it would give them some basis really to take into account that expert judgment coming from national level about what's going on. And actually, when we released this last week, the former chair of the Eurogroup, Arun Dieselplan, put a very good point here. He said, basically, if the governments know the Commission is taking this stuff seriously, the governments will take the IFIs seriously. And I think that's a really strong point. And we've had a lot of problems, and it's true in the country where I'm chair of the Fiscal Council in Ireland, where the Commission takes one view, often more lax than the IFIs, and that undermines the position of the national institutions very strongly. The government turns around and said, well, the Commission said it was okay, and then it makes a mockery, essentially, of the role of the IFIs. So this is a very important point. And basically, there are three areas where the IFIs could help. One is looking at compliance with national fiscal rules that essentially mirror the EU requirements. A second area is lots of measurement issues. Implementing the rules are quite complicated. I think the IFIs are very well placed to assess those kinds of things like one-offs, discretionary revenue measures, DRMs, potential output, and the like. And the third part is making an overall assessment of fiscal sustainability on a regular basis. This in some ways is a little bit like what Blanchard is talking about, the DSA. When the Commission or the European institutions are thinking, is this country making a serious policy mistake? I think the IFIs actually should be in a good place to make a judgment, say, yes, this is fine, or no, there's a really serious problem here, and people at the European level should take action. Of course, to do this, the IFIs and the EFBs made this point, not all IFIs are equal, and if they're to play this role, there needs to be a strengthening of the IFIs, and setting minimum standards at the EU level could be very helpful in that regard. A number of things are important: access to information, resources, independence. Some IFIs have very strong setups in that regard, others much less so. So this is an essential element to support the IFIs having a bigger role at the EU level. And the final aspect is data and other information. So this bit often gets ignored, but it's one of actually the big achievements of the European framework, is just to improve the information. We can only have the discussions we have because the data is provided. And there's a number of areas where improvements could be made. Maybe the first one is actually all countries should provide credible forecasts 4 years ahead. If you're going to have a medium-term framework, people have got to be producing medium-term forecasts. It's not the case today. The second is basically to improve the measures of potential output. At least some of us believe that there's significant scope to improve those measures and to improve the assessment of those things. And as Katrine rightly said, even if you move away from the output gap, inevitably you have to take some view of the medium term, and that comes down to a view on potential. So that's something we should always be improving, even if we recognize it can never be done perfectly. And there's a whole set of other things that could be improved around one-offs, around discretionary measures, and the like. So let me just leave you with the key messages. And I think basically we're saying that whatever happens to the rules, there's scope for improvement, and we would really focus on the need to have a multi-year approach. The role of the IFIs should be enhanced through this obligation to take these assessments into account. That also requires minimum standards for the IFIs, and more information could be provided. And each of these things together is stronger than any one of them alone. Thanks very much for your time.
Thank you, Sebastian. Interesting. Is there any quick intervention immediately, or will we discuss it later? Otherwise, I will hand over to Cynthia. I should not introduce her. She's a Director of Research at CEPS. Thank you for being here.
Thanks very much, Christian, and good to be in the panel with Sebastian and Katrine. I will actually react or reinforce maybe some of the points that Sebastian just made. I prepared few slides. I decided to go for the big picture, also because I'm the seventh speaker of the day, so it's quite difficult to say something new, but let me try. Maybe first a disclaimer. I'm actually not trying to put forward a proposal for the fiscal rules which are needed in the post-COVID. I will try rather to summarize some of the points which have been already made in terms of trade-offs and risks, and then make a guess of what we can expect for the future in terms of reforms. This will be also the way maybe to generate some reactions from the other panelists and among the participants. Let me just start with a bit of, let's call it background. I think it's clear from the discussion that we had in the past couple of hours that the reform of the fiscal framework is very complex exercise, so there is no silver bullet. And I think the complexity comes both from the economic and the political side. If basically you go back to the discussion that we had, I think I can safely say that there is no full consensus among economists, at least not yet, on what kind of rules are needed. And the second point from a more political point of view is that member states have different views. This has already been the case, and I think it will be reinforced maybe next year on the following one. And these different views reflect different political preferences. I mean, this is not new. I mean, for instance, in some countries, rules are important and necessary, regardless of being part in a monetary union. I guess the IFIs are essentially, first and foremost, actors which deal with national rules. We also have national rules, not only European rules. And the second point why we have member states with different views is that the current conditions are actually different. Just think of the level of debt. I think we are, the level of debt ranges between 18% in Estonia and about 200 in Greece. So the range is extremely large. The one point on which there is actually a broad consensus is that the SGP has proven inadequate. Now, then the question is, will we be able to move towards a full reform of the SGP? And there, for me, the answer is rather no. So changes will be actually quite limited. And I think there are two reasons. One is, if you want, is practical. I think we have a very little time. As Sebastian already said, basically we need to have something certain by the end of 2022 to know whether the SGP is back in force as before in 2023, or we have something new. And we are still in a situation of high uncertainty related to the pandemic. The second point is that in practice, if we want to have a major change of the SGP, I think we really need to ask a very fundamental question, which is what is the rationale for having EU fiscal rules? Now, if we go back to Maastricht, I think that there were two major points. First one is to achieve a reduction or lower that level in an environment, certain environment, which was the one of the 90s. I think Klaus Regling reminded us in a very clear way, and the need to minimize fiscal spillovers. The second point was really to have policy coordination in the absence of a common budget. Then the question is, are these two conditions, if you want, still relevant in today's environment? And there, I think the answer is twofold. I think that integration is much deeper today than in the 90s. So in a sense, we should expect that actually the potential for spillover is even higher than it was then. The second point is that coordination has not worked well. Current rules are complex, ineffective, and difficult to enforce. Plus, I think we really need to consider actually what has changed and whether the changes actually require a major modification or update of the Stability and Growth Pact. And I think that there are 3 points which are quite fundamental. I think everyone tends to agree upon, but will not necessarily be taken into consideration. And the first one is really that sovereign debt is now much higher than it was in the 90s. And more importantly, this is going to stay there for very, very, very long time. The second point, and this is maybe less recognized, is that in the context of Maastricht, the theory which was behind the thinking was the optimum currency area theory. This was not formally, not necessarily the theory behind it, but many people had that theory in mind. And in that context, the real issue was asymmetric shocks. I think that since the financial crisis and COVID, two huge crises, and basically in a decade, the attention has moved much more on common shocks. And the reasoning is actually quite different when you have asymmetric shocks and common shocks. The third point is that basically we do not have an EU fiscal capacity. That's clearly not the case. But the Next Generation EU broke a major taboo in the EU debate with the issuance of common debt. And whether this is not an instrument which is assumed to stay there as a permanent one, a major change has been made. Now, I think these are quite fundamental questions, but I think that in practice will not be considered. And I believe that actually most of the debate in terms of changing, reforming the fiscal framework actually will be driven by two aspects: the objectives of the rules and the limitations of the rules. I think all these elements came up in the discussion, but I think it's important to look at these two dimensions at the same time because they're actually very much connected. Now, on the objectives of the rules, I think it was stated several times that fiscal sustainability is clearly the main one. And I think there is a broad consensus that should remain the main one. But following COVID, I think broadly two others have been added. One is, I would say, growth/investment. Think of the debate about green investment or support for digital investment. And on the other side, I think we didn't mention it today, but it has been part of the debate, is the need to complement monetary policy, so to have fiscal policy complementing a monetary policy. And then we have decided what should be fixed in the rules. And I think there are three main points: complexity, procyclicality, and lack of enforcement. Now, I think if we take all these points seriously, I think we need to recognize that if we increase the number of objectives, the complexity of the framework will have to increase. This is, I think, is quite straightforward. What is less straightforward is whether increasing the objectives of the rules actually reduce the procyclicality of the rules, and whether it boosts the enforcement. This, for me, is still open question, but let me try to make a few points which may help to answer the question. Now, I start from the assumption that rules in a monetary union are necessary. I think the idea of standards that was mentioned earlier may be intellectually appealing. I think in practice, it will not work. I think fiscal sustainability should remain the main objective. And I also assume that there won't be a major change in the SGP. But for the changes that will be made, and I think this goes also in the direction of some of the points that were raised earlier, I think we need to start from the point that fiscal rules cannot address all possible fiscal issues. And we also need to think that other instruments can be considered. At the same time, we should avoid a situation whereby fiscal rules actually become a source of problems. The second point is that there are out there many different proposals. I don't want to go into all the details of each of them, actually of none of them, but I want to reinforce very strongly a point that was made by Sebastian, which is that rules should be tested and simulated in advance. I think it's actually the only way to understand what would imply the implementation of a certain rule, even in the current situation, and how actually the implications are different across countries. I think we have enough tools and enough human capital to do this exercise, and I think it should be done just to see what we get, keeping in mind that rules should be forward-looking at the number of exceptional circumstances in the future may increase. So the number of circumstances under which the rules may not be applied may increase. Think of health crisis, think of refugee, of security measures, or natural disaster. So this, I think, is something to keep in mind. And this leads us basically to a number of trade-offs which will remain in place in the changes that basically I kind of envisage, and the number of risks. In terms of trade-off, is really, the first one is really about the complexity. And the fact that complexity is mostly the outcome of flexibility when there is no discretionary power. The point was also made by Sebastian. And if we want to move to a very simple framework, then we need to be ready to have a system which is much more rigid. Simple rules usually are much more rigid. Multiple objectives lead to complexity. And the last point is that counter-cyclical fiscal policy, I think, is highly desirable, but I think in practice works only very rarely. And in fact, I would argue that is more often the case in good times than in bad times. And then the last point is really on the risks that we may face going in this direction and should be taken into consideration. Is that the first one is that if we keep in place rules which are outdated, let's think of the 60% that was mentioned earlier, for instance, by Klaus Regling. I think it will inevitably mean that at some point, such rule will have to be overcome, which in practice means to have a system which is flexible, or whereby there is some discretionary judgment, because basically it means that it's the only way to get around a rule. And a crucial question is actually who will have the discretionary power to issue a judgment, assuming that we want to have a less complex system. The second risk, I think is going to result from the very heterogeneous situation in terms of national fiscal positions, which may lead to different needs and different views. And then the last point is that what I call the guardian of the rules, both the Commission and the IFIs, actually will need to have some support at national level in order to be able to perform their task. And a question is whether any kind of reform of the SGP can actually lead to this situation. And then let me close basically summarizing some of the points and issues that I mentioned earlier. So my expectation is that we will not have an overhaul of the Stability and Growth Pact. So I expect no treaty change. So the 3% and the 60% in particular will remain there. But oddly enough, the 60% will be a less relevant benchmark, while the focus will be much more on debt than on deficit. The second point is that operational rules, I think this is a bit my guess, and the way really in which the fiscal pattern will have to be adjusted towards the target will remain the main area where the change will intervene. And I also expect that complexity will somehow be reduced, though not completely. One important point, which I think is not only technical and which was made by Sebastian, is that there is a high demand for improvement in statistics and in transparency. I think this is actually crucial to have to increase and improve trust among the member states. We should not forget that in some of the countries which got in troubles after the financial crisis, this was still a major issue. And then the main question where uncertainty is actually still very high is basically the definition of maybe further flexibility or a different flexibility compared to the one we have now, and therefore to establish who decides and which circumstances. So overall, I think that these are the change that we are going to see, which implies that some of the issues will remain unaddressed. So we will not have a perfect framework. I think that the main point will be whether this will still be enough to improve the credibility and the enforceability of the new framework. I will stop it here. Thank you.
Yeah, thank you, Cynthia. That's great. So we can go ahead with the discussion. First, we can start with some questions in the panel, in the second panel. Cynthia, I like the way you frame it. I mean, there's a trade-off between complexity and let's say, and stringency, or let's say, how did you frame it? Strictness. Probably you have a very strict rule if you have a one single indicator rule. Is it would you assume that we can go back to that kind of small easy indicator like the 3% rule or something like that, as you mentioned?
Well, my guess would be that the 3% headline will remain there. Then the real question is on the operational rules and how over time this will impact basically the fiscal policy. And I think some degree of complexity will remain. So I do not believe that everything will be removed and only the 3% rule will be neither the solution nor actually the main scenario. That's at least my expectation.
Yeah, I think that is reasonable, because if you want to take into account other ideas like cyclical adjustment, investment, whatever, inflation, expenditure rules, it makes it quite complex. And then here you have the trade-off. So, and then you can complain about how to estimate cyclical deficits and all that stuff. Catherine, maybe I can ask you to your proposal. Basically, I did not get it. You were saying you are not very much in line with Blanchard, with the fiscal standards approach. Even it would be quite flexible because of the that sustainability analysis, which is probably difficult to assess. But what would be your approach?
Yes, correct. So what I think is a very good idea in Blanchard principle is to account for qualitative issues in terms of the macroeconomic framework which you have in the euro area. And my point is that it's very difficult to, as a criticism to Blanchard proposals, is that we don't know how to assess that sustainability. So if we go along that route, there will be no economist available to tell you for sure, is that debt sustainable or not? That is always a big topic among economists, but we don't know how to define debt sustainability. What we know at the moment, for instance, is that there is no doubt about debt sustainability in the euro area, because we have a central bank, which is there, which is placed as a lender of last resort. And so the assets, the public bonds, which are issued by the governments, are considered to be safe, and debt is sustainable. But we don't know how to assess what is the appropriate level for debt sustainability. So that's one of the criticisms I have towards the approach chosen by Blanchard and his colleagues. And what my proposal is really to change, to abandon the rules and to go for discretion, and to have an open coordination process in the euro area. That is to say, if there is all countries have to all member states have to implement a policy which allows their countries to meet the 2% inflation target in the euro area, the ECB's target, okay? And then, as long as they meet this target, they may well decide to run expansionary fiscal policies or restrictive fiscal policies, depending on their domestic situation. You may be in a case, let's say Spain, for instance, before the financial crisis, where it was the good pupil of the euro area. It had very low public deficits and debts. It was one of the best pupils according to the rules. But there was a big rise in private debt in Spain at that time. There was a burst of the bubble when the financial crisis started. And what I say is that before this crisis arrived, Spain should have run a more restrictive fiscal policy to reduce the private indebtedness bubble in Spain. So each country should run fiscal policies which are in line with their domestic needs. Might be contractionary, might be expansionary, as long as it meets the 2% inflation target, as long as they do not generate spillovers to other countries. And this is really important if you want to reduce the imbalances among euro area countries, because still today we have countries with huge current account surpluses, Germany, the Netherlands, and we have countries which have seen their current surpluses being reduced because there was low demand. But if we start again, let us be in a post-COVID-19 crisis, we will have to think about having fiscal policies which differ according to the countries and which meet the domestic situation, cyclical needs, which you cannot do with the same rule with everyone.
This is an interesting point. I think I would like to highlight that the 2% inflation idea, as well as the rules we have actually in place in Europe regarding the current account. It could be reasonable to give member states that have low inflation and quite a lot of competitiveness and high current account balances more fiscal space, so that it can inflate the economy a bit. Nevertheless, it makes it more complex, probably. So that's the other side. But interesting thing to combine these aspects. Cynthia, there's a response of you.
I would like to actually ask a question to Catherine. Why would you give to fiscal policy the objective of 2% inflation, which is in principle the one of the central bank?
My point is that we are in a monetary union. So there is a common monetary policy, but we don't have, but we still have domestic fiscal policies. There is a common inflation target for all the euro area. So the only way to rebalance the economies within the monetary union, when you have domestic fiscal policies and a common monetary policy, is to say to each country, well, follow the inflation target, or it may be 2% or it may be another target, but follow the inflation target, more or less with a certain margin. Make sure that you have wages which grow in your economy in line with this target. And the only tool which you have to adjust macroeconomic policy is fiscal policy, and then adjust fiscal policy if you are in an economy, if your economy there is some overheating for specific reasons, then have more restrictive fiscal policies, or if in your economy there is high unemployment, low growth, then have an expansionary fiscal policy. That is, I'm talking about short-term stabilization measures to have your economy growing again. So the fiscal policy is the only stabilization tool when you are in a monetary union with a common inflation target.
I would like to add that it is also maybe an idea of even in the context of a common shock to stabilize, because monetary policy in the liquidity trap and the zero lower bound framework is quite limited. Maybe a proposal for a common budget, in EU budget, for example, to stimulate the EU economy in the presence of a common shock. If monetary policy is not really possible, I mean, just as a question, even to you, Cynthia, because you were mentioning the common versus non-common shock, asymmetric shock.
If I may start, well, in the case of the COVID-19 crisis, for instance, well, we have seen that the ECB was very efficient to stimulate or to limit the falling outputs in the economies. I agree with you, there is a limit when you reach the zero lower bound, okay, but there are other tools which the central bank has used, like purchasing assets and so on, to help the economies. So in the case of common shocks, we don't have any specific problems, any stabilization problems as such. The problem we have in terms of stabilization is that when we are in situation like we were when we joined the single currencies, and that there is no common shock affecting the economy, so before the financial crisis, before the COVID-19 crisis, then we are all asked, all member states are asked to fulfill rules, fiscal rules, which are the same for all countries. 3%, less than 3% of GDP for deficit, less than 60% of GDP for debts. But 3% of GDP of deficit for a country, this does not mean anything. In some situations, if you have overeating in the country should run a restrictive fiscal policies. If the country is in a situation with low demand, it should run an expansionary fiscal policy. So that cannot be in a monetary union the same single fiscal deficit criteria, whatever the domestic situation is in terms of short-term business cycle conditions.
Cynthia, you like to respond as well, or should I go ahead?
Very quickly on the case of common shocks. I mean, in principle, as the monetary policy, which is common, which should respond. And when it comes on the fiscal side, I'm taking out from the drawer proposal, which we made a few years ago, which is about a common unemployment insurance mechanism, which I think could be a good mechanism for stabilization purpose when it comes basically to common shocks, large shocks. So just a reminder of some of the work we have done in the past.
There is one question regarding the independent fiscal councils, and another one on debt servicing costs. They are decisive. Why not fix a flexible debt ratio, one that goes down as soon as debt services costs rise? I think it is kind of related to the flexible approach Olivier Blanchard mentioned. And another question on the independent fiscal councils. They are an important improvement, yet fiscal councils face legitimation concerns in the political sphere. Why should we make rules not more automatic in order to reduce political discretion in the euro area? If I can add, Sebastian, we have so many ideas and complexity, so many goals. Maybe we cannot have one rule, and maybe it would be a big role for the independent fiscal councils to fill that gap.
So a couple of thoughts on that. So I think first, there's a question about what you're trying to achieve with the European rules. Are you just trying to provide some kind of safeguard, or are you trying to run policy optimally at the national level? And I think there's no simple answer to that. Actually, it's a balance between that. I think clearly the European institutions have to make sure that other countries aren't endangering other countries. But the difference between running a policy that's suboptimal and one that's risky, may be quite a fine distinction. So I think it's hard to separate those things, but I also think it's difficult from Brussels to try and impose the optimal and policy that takes everything into account in the country. So there's an element of a balancing act to be found between the right role for the European and the right role for the domestic aspects. I think on the role of IFIs, it's a good question. Some of the proposals that are out there for the role of IFIs make IFIs themselves very uncomfortable in that they give us too big a role, and there's limits to what the IFIs do. There's a practical role today because some IFIs don't have the resources or the institutional framework they need to be able to play much of a role, and that's one of the reasons we're arguing for minimum standards. But it's also, even with the best IFI in the world, there are things that IFIs can't do. We can't substitute ourselves for the democratic process. That would be absolutely wrong that we did. The actual underlying thing, and I think it's worth discussing actually in this context, that one of the reasons to be a little bit skeptical about discretion run by a political process, whether that's a national political process or whether it's a European discussion that's influenced by national politics, goes back to the reason we have IFIs. The reason why we have IFIs is essentially because we know that in many political systems, there's a tendency towards short-termism. The political cycle is maybe 5 years. The news cycle is about 15 seconds. And governments tend to, we know there's a temptation for governments, even if they're well-intentioned, which maybe they're not all, but even if they're well-intentioned, there's a temptation to take short-run risks, basically to spend too much, not pay enough for taxes, and kick the can down the road to another day or to another government, or just hoping something will turn up. And the whole point of having fiscal rules and of having institutions is it's a way of the government committing to it, saying, I know I'm likely to do this, so what I'm going to do is I'm going to make this commitment. Now, once you have the rules as a commitment, you then need someone to monitor their compliance. And particularly if the government turns around and says, well, actually, there have been exceptional circumstances, I couldn't have anticipated that I wasn't going to meet them. And that's exactly why you need the IFIs. So we're not trying to substitute ourselves. What we're really about is increasing transparency. It's very hard for you as a citizen probably to read the budget document in your own country. It's too complex to really understand that. You need databases, you need economists, write stuff that people don't have at home. And so what we can do as IFIs, and I know this is true in the Irish experience, is we can explain to people very clearly whether the government's doing what it says, whether this is in line with something that's economically sustainable if you take it forward. And we can explain to people those choices. And that's all we can really do. But potentially it's a very important role. So I think it doesn't overstep the limit in terms of the democratic thing. I actually think it strengthens the democratic process. Politicians should always make the choices. But I think having that as part of the system, and of course, a lot of our political debate remains very national. And that's one of the strengths of the IFI, is that we can really engage with the process. I mean, I know we're about to put out a report in Ireland tomorrow. I would pretty much bet it would be front page news in Ireland. I can't remember the last time a fiscal publication from the Commission probably made it into the news in Ireland, yet alone got that kind of coverage. So it really allows us to go out and explain things to people. And actually, I guess that's positive about democracy, that if you explain things to people, people actually do often respond better than many people might assume.
Thank you. That's a positive way of seeing it. On the other hand, it is not easy to find a consensus, as we know, as Cynthia said, a lot of people and proposals differ. There's no consensus, but there's one consensus, that we cannot go back to the old rules probably, or that the old rules are not sufficient. So one other thing you mentioned, may I ask you about that, Sebastian? The compliance with the national fiscal rules was also a point I think Philippa mentioned in the first session. What I've thought about is how will you ensure that, because the fiscal rules at the national level came into effect after the SGP reform in the Euro crisis, and after the blueprint of the German fiscal rule, the debt break, and so how will you now ensure that reform can be in line with the national fiscal rules, which are basically more or less probably the German fiscal rule?
I think that's actually a very serious issue, and one that not many people have really engaged with. I mean, it's a general issue about reforming the pact and legal changes that be required and how feasible that is. But there's a specific issue with the fiscal compact. In Ireland, we had a referendum to approve it. So if we want to get rid of it, it's not going to be easy. It enshrines the rules as they were in about 2014. The rules have changed since then. Now, most of these rules have various get-outs, but that leads you basically into a territory where you claim you have a system of rules, but de facto it's a system of discretion operated by the Commission. And as we've said, one of the big issues that IFIs face is precisely that once the discretion is really in the European political process, that can be very undermining of the analysis of the IFIs. We're quite rightly not part of that process. We're not, we're not around the table. But when that process comes up with a judgment, what do the IFIs do in that case? It's very, very awkward for us. And that's why we think this obligation at the European level to take into account what the IFIs say would be very helpful, I think. I think it would give a little bit more leeway at the central level, and it would make sure that they were listening a bit more to what was actually going on in countries. I know in our case, a big concern, the Irish case, a very idiosyncratic one, is to do with the heavy reliance on corporation tax. It's very volatile. But for us, it's a major thing in the public finances. It's one of our top 3 risks in the Irish public finances, but it's not taken into account anywhere in the European framework. And so where we say the government should be more cautious because of this over-reliance, it just doesn't fit into the EU framework. The Commission then says the budget is fine, and the government says, well, that's okay. And that undermines us as an IFI and undermines domestic process. And I think it's very important the European level doesn't do that.
Thank you. I guess we are running out of time, but nevertheless, let me raise one more question. As most of the proposals have some ideas on how to treat public investment. And we were discussing whether we can define it properly. Do you think, Cynthia, or I don't know, to anybody else here, that there is a consensus of how to define it, that we will make it next year to find a consensus on that?
I'm actually quite skeptical on this. Not only, let's say, because it will be very difficult to put them into the SGP, or let's call it the fiscal framework, and measures basically to what extent they are going to reduce the deficit which is relevant for the rules. I think that there is a serious difficulty in identifying what is a green investment, in the case of the green investment, which in principle is an investment that should reduce CO2 emissions. So in fact, for each different investment project, one should assess what is the CO2 reduction, which could be some direct impact or some very indirect impact. So actually, we are starting a small research project in-house to look in detail into these issues. But what we are seeing is that this exercise is actually extremely complicated if we want to take seriously CO2 emission as basically main criterion for measuring what could be called a green investment.
Yeah, that would be a challenge, but nevertheless, a lot of proposals include these challenges. I would suggest if there's any comment from your side, maybe from Daniel, Roel, or Carlos as well, we can discuss them. Otherwise, I can. There's Daniel.
I would have one question, perhaps. I don't know to whom, but I'm asking myself, what is the hurry?
Good question.
If the fiscal rules, the existing fiscal rules, were imposed in 2023, what would happen? Nothing, basically. Countries would just have to follow an adjustment path, which I think is 0.5 percentage points of GDP. So what's the big deal? And if I saw the adjustment path for the Spanish figures, actually it would be quicker than that.
I think Roel had a discussion in the first session as well on that, but I don't know whether you want to respond, Catherine, first, given you raised your hand.
Yes, thank you very much. Well, I think if we were to apply, again, the rules as they are in the treaties from 2022 or 2023, a lot already would happen, because we are going to be, let's hope COVID-19 is just around, now not starting again. Okay, if we apply the rules again, well, we know we need to make a lot of investment in terms of environmental transition. Even under the Commission's estimate, this public investment needed is 2% of GDP per year, and it's probably much higher. So how are we going to be able to apply the rules? We will, almost all member states will have higher than 3% of GDP deficits. They will have to reduce these deficits as rapidly as possible, so that they will not invest. And what are we going to say to the future generations? How are we going to meet the targets which we try to keep on within the COP26, and it's already hard to imagine we are going to be able to meet our targets in the long term in terms of climate change. And so, well, if we implement the rules again, we are not going to be able simply to do the required investment. That's in short.
Thank you, Catherine. Roel.
Yeah, thank you, Christian. Just a few words on this. You see, I think the point is that if we re-enter the pact or the application of the pact, if it is not reformed, then we enter into an immediate violation of the rules, and so I'm not sure that this will not be helpful for the credibility of the pact. So this is for this reason, as European Fiscal Board, we thought it would be best if there would at least be kind of a blueprint of a reformed system before the general escape clause is lifted, so that the Commission could apply its surveillance in line with the with the forthcoming revision of the pact.
Sebastian.
So I think our concern about the urgency is really that we wouldn't want to move to a prolonged system of discretion along the lines of the general escape clause, because we think that would be harmful to the whole framework, really. But I think actually what you see here is an interesting discussion between Daniel and Roel on the facts, which is why you need testing, in the sense that I think Daniel's view, as I understand it, is if you actually forecast forward and you look forwards, the implications of the current rules aren't too bad. Roel seems more concerned than that. I don't know who's right. I haven't run the numbers myself and looked across it for different countries, but that's why it's ultimately an empirical question. But I think I have a lot of sympathy with what Daniel's saying, which I think is that I think a lot of the debate seems to assume the rules are more different than they actually are. But actually, if you run through some version of the European rules I showed in the current rules I showed in my diagram, you might not end up with something very different than what people are proposing. Now, it's different, so you have to take a view as to which version you prefer and what performs better for which countries. And there's a sort of trade-off in terms of the amount of front loading and stuff like that. So someone's got to make a choice, but they might not be that different from each other. And I think also coming out of the crisis, I think people haven't necessarily fully internalized the fact that interest rates have fallen so much, and also the fact that debt's gone up, actually means that, for a given budget balance, you kind of end up with a relatively similar picture in some ways from the one you did before in terms of debt dynamics. So I think that's also an important factor that needs to be internalized. And that's why, so I think Daniel's suggesting maybe the current rules aren't too far away from it. And I certainly think, actually, and this is just my personal view, I think the 0.5 adjustment rule within the European framework is not a bad benchmark and bad trade-off between making a reasonable adjustment but not asking for too much, or something that draws too much from demand. Obviously, you have to be careful about everyone doing it at the same time. But I think it's actually not a bad approach to guiding fiscal policy. If you think fiscal policy is not where it should be, having a process of correcting in those steps is probably not a bad way of finding the way back to the good path.
Okay, thank you. I think we have to close soon. I just want to use the opportunity to raise one question to Roel, given he's in this session now, and because this is on fiscal rules and how to make a reform proposal, and you have one in the European Fiscal Board. Do you think this proposal has a chance to become reality in 2023? I think that 60% and the 3% limit is quite similar to, I think, to what Cynthia also mentioned.
Yes, so I think the 60% and the 3% will be very difficult to alter, and I think they will stay. But the question is, when we're talking about the 60%, the question is, when should it be reached? And I think the current 1/20th rule will, maybe in the very short run, countries will be able to adhere to that, but not in the longer run. But of course, the period for reaching the 60% can be made very long. And so basically that is the same as differentiating the debt reduction speed, which I think we cannot avoid that, given the reality of the very different debt levels. Now, on our proposal, I think I understand there's a lot of agreement, at least among experts, many people from international institutions, that debt sustainability is the key element, and that an expenditure benchmark is actually a better way to steer towards the kind of the long run debt limit, because an expenditure benchmark relies less on unobservable variables. I mean, not entirely, because our proposal is linked to expenditure increasing in line with potential output, with a correction factor, but the measurement error in potential output growth is less than in the output gap and in the structural balance. So I see, at least among maybe kind of these experts, I see quite a lot of consensus emerging. Thank you.
Thank you, Roel. Yes, that was the expenditure rule also that Catherine explained in her talk. I think that has a lot of chances indeed, because the growth rate is quite less prone to revisions, as we have seen in the gap estimates. I'm sorry, I have to close the session. We are already behind the closing time. Cynthia, should I give the words to you and you back to me later, or should I close?
Very quickly from my side, I would like to thank all the speakers in this session and the previous session for the very interesting conversation. I think we have learned a few things, but still quite a lot of points are open for discussion. So I'm sure that the whole year 2022 will be one on which this debate will continue. And it was a very nice opportunity to meet all of you. Unfortunately, again, on screen. I hope at some point we will meet in person, and thanks very much, and over to you, Christian.
Yes, thank you also to everybody in the session and to the other speakers we had here. Thank you for the invitation also, and CEPS. We learned a lot, I think, indeed, we learned a lot about debt sustainability, that we have controversial views on how to assess debt sustainability. We have controversial views of what exactly is necessary when we want to reform the Stability and Growth Compact. There are obviously a lot of questions. The 60% debt limit is questionable. The 3% deficit limit is questionable. The basically everything is questionable. We don't know how to assess investment, how to assess business cycles. Probably the growth rate and the inflation rate we want to achieve, or at least estimate the growth rate within the expenditure approach, could be something, as far as I see it, that we can with reasonable security estimate, but let's see what we will find out next year. I'm also I don't know, this is the third winter when we have the COVID crisis, and I'm even skeptical that the next winter we will have not the COVID crisis, or the COVID crisis is probably not over even next year, and I don't know whether we need the escape clause even in 2024. That's a pessimistic view, but let's see. The next year will be very interesting. Again, I thank everybody, the CEPS team, Cynthia, Daniel, Vasilina, the Intereconomics team, Katja and Jiffer. Thanks to everybody who listened and participated. The Intereconomics issue comes out in January 2020. And yeah, thank you to be there, and see you probably next year.
Bye-bye.
Bye-bye.
Have a good evening.